I should unmute myself. Good morning. Welcome to our next installment of Brownfield's Quarterly Market Outlook webinar series. With us today are some of my favorite ag economists, Daryl Peel with Oklahoma State University, Lee Schultz with Iowa State, and as always, University of Missouri, Scott Brown. Good morning, everyone.
Good morning.
Today is really an opportunity for us to do a couple of things. We're going to take a look back. We're a year out from the COVID-19 shutdown, which I think we started these just about a year ago. And then we're headed into a year of hopefully continued recovery to not just the ag economy, but the economy in general. So to get things started this morning, I just would like you guys to maybe summarize some of the things and the changes you've seen and you've watched in the ag and in the livestock sector over the last year. Daryl, we'll start with you.
Sure. Good morning, everyone. And thanks for the opportunity to be a part of this. Looking back over the last year, obviously our economy in general, certainly the ag economy, has been challenged in ways that we've never seen before. And speaking specifically about the beef industry, I have a slide. I've made a couple of presentations of kind of what we've been through and where we are. And the highlights, I guess, are that I think the pandemic the last year has revealed, in the case of beef markets, really brought to light a lot of the complexity of the cattle and beef industry and those markets, particularly at the food level. So we think about the supply chain issues that we faced this last year. And then, really it's highlighted a lot about how markets really work. And I think some of that was a surprise to some people. And so we look back on kind of how we got through what we did. In my view, as an economist, I think the markets, for the most part, did a really good job and behaved exactly like I would expect them to. But because of the magnitude of the shocks that we faced, I think a lot of times it was a little bit surprising to people, sort of what was happening and maybe a challenge to sort of understand why. And again, it really highlighted the fact that these markets are enormously complex. So we've gotten through it. The majority of it, we're still working our way through the last part of it. And so, looking forward from here with, in general, quite a lot of optimism, I think, built into, in general, into this entire protein complex.
Lee, we'll talk to you a little bit too, and I'm sure your focus today will be mostly on the hog and the swine sector, but what are some of your observations from the last year?
Well, I'd concur much the same with Daryl. I think, really what came very apparent to me was just the biologies of this industry. And if I speak specifically to the pork industry, when we looked at this last hog and pigs report, for example, there were some surprises. I mean, the numbers were well below year ago levels. They were even below pre-report expectations. But I think when we thought about it more, really 10 months ago was when those decisions were being made that were dictating those inventories. And that was the throes of the pandemic. And so that really highlights me. Also, I think we've been talking about demand a lot and really how that's helped in this recovery. And it has been incredible. And I think we could make some examples here. But the cost push factors are very much at play as well. A lot's being talked about the feed situation, that we've seen corn prices, bean meal prices, where they're at. But I think there's a lot of additional costs that maybe we haven't talked about as much that are very much at play. Labor, wage rates have continued to increase. Really, I think that's one of the shortages we can talk about is just farm employees, just ag sector employees. That's increased costs there. And then just some of those maybe unhidden costs. We know building supplies have really crept up, and that's contributing to higher costs. Custom services, we're seeing much higher costs there. And so there's these factors that I think are also pushing prices higher. It's not just demand, it's that cost situation too.
Thank you, Lee. Scott, we'll finish up with you.
I'll try to add here to what my colleagues have already said that certainly are the important issues. I just remind us, if you just back the tape recorder up 1 year ago and think about where we were at this time a year ago, I think many of us were very concerned about just how everything would unfold. I'm sitting here going, we were about 250,000 head of weekly slaughter or daily slaughter of hogs. And so kind of at the low, and I think there was a lot of concern about how quickly could all that turn around in the face of COVID-19. I'll just say, I'm amazed how resilient all of these livestock industries have been to what is a major shock in the system that I don't think any of us pre-COVID-19 would have thought these industries were ever going to have to survive what was a very massive change. And
Yeah.
we sit here in April of 2021, by and large, with some pretty positive outlook. I'm not sure we would have been there a year ago and would have said it's going to take us a long time and we're going to have some serious issues. So just how resilient and how quickly we adapted to the situation. I go, now we're in the piece of this where what does demand really look like going forward? Again, let's not forget we've come through a very unprecedented period for a number of years. It's tough to decide how demand plays out going forward. There's a lot of reasons for some short-term optimism for sure. But I'll close back to Lee's point about costs and the increases in costs that we're seeing. I will say COVID-19 has put costs in a number of pieces of getting things from farm to retail, input prices, that I think it's going to take us a while to figure out exactly all the implications of that. But those increasing costs are going to have impacts on ultimately what we produce in terms of cattle and hogs in this country. And so we're not done, as I think Darrell alluded to. We're hopefully starting to see the end point and maybe some more positive as we talk about what I think could be some strong domestic demand for things like beef and pork going forward. But the cost side is something we will have to pay attention to.
So we talk about a year ago, just less than a year ago, we saw that massive disruption to the supply chain. Would you have ever thought, and Darrell and Lee, we could have made the recovery as quickly as we can to get things back online and be back on track with daily slaughter totals or catching up through those backlogs that we had? Lee, I'll start with you.
It's certainly difficult to put it in perspective, right? For the hog industry, I think there was some parallels made to 1998 and some of the disruptions we've seen in loss of capacity. But, really, those were much different situations. And so I think it was really difficult to benchmark the recovery process or how fast we could get out of that. I think the important thing to highlight is it was a tremendously coordinated effort. I think all of us on this call were very involved in the industries, from all the way from state governments to federal governments to the state associations to national associations. I've really never experienced something quite like that, and just the coordinated effort in providing information, but also just the help that was offered. Now, that was really the easy part, right? It was the producers, it was the stakeholders throughout the industry that really carried the water, right? And I think that was what was so impressive to me, that the ability to stage animals through the supply chain as we ramped up those processing levels, the ability to do Saturday slaughters as long as we did, and to get those processing plants back up online, what was truly amazing. I think what that has done, one of those unintended consequences, is that certainly provided for maybe greater resilience in the next disruption. So we don't want to necessarily see anything like this or anything like that. But really, I mean, I think that's what the true positive story out of this was, yes, how maybe quickly we recovered than we thought, but also our ability to respond next time when we see something.
Darrell?
Yeah, there's several things I think that were surprising, kind of as it happened. Certainly looking back on it from my standpoint, obviously going into it, we had so much uncertainty about just exactly how things were going to play out and sort of where the bottom was. you look at both cattle and hog slaughter really kind of went down pretty much through the month of April to a bottom near the end of the month, at least on the cattle side. I think hogs was similar. And then we turn around and so it was about 4 weeks of weekly declines to the low, and then and really within about 4 or 5 weeks after that, we were pretty much back on track from a cattle slaughter standpoint. That's faster than I would have expected in some sense, although I think I was not as pessimistic as some people maybe during that process. But so there was that surprise. Obviously, as Lee alluded to, on both the hog side and on the cattle side, there were a tremendous amount of disruptions and ripple effects then back in the live animal part of the industries in terms of how you change the flows and the timing of animals coming through the system and deal with that backlog that it created and so on. And that's probably the part that took the longest, frankly, in both cases to sort of work its way through the system. And you can make an argument that in some sense, there's still some ripple effects from that a little bit. The other part that was surprising to me was given the massive disruption that we had on the food side, on the demand side, really, by taking away essentially half of the market and essentially closing food service very abruptly. And that's, roughly 50% of food consumption. The ability of all of the supply chain folks and the various retail sectors and then the wholesale processing sectors to make adjustments. There were some massive disruptions, but again, they were in some sense remarkably short-lived. And through it all, demand was very resilient, as Scott alluded to earlier, through this whole thing. And even though we're still not fully recovered on the food service side and won't be probably for some time yet, but we're working our way back to it. Demand has been really one of the truly key factors to getting through this with, the level of impacts that we've seen could have been significantly worse.
Probably the most overused word in 2020 was pivot. And I hate to bring that up today, and I cringe a little bit as I say it, but we did a lot of that. And we saw specifically on the demand side of things, does it also present opportunities for us as we look ahead to 2021 to have just an additional source? So restaurants, I know where I live, have figured out, restaurants, breweries, you name it, have figured out ways to keep their product moving and keep customers coming in. Does it also present opportunities to increase that demand sector when the economy and things start to open back up and get to return to more of a normal situation? And how do the industries potentially see and work through that increase in demand? Do we see that opportunity as well? Scott, I'm going to start with you.
All right, thanks, Megan. So I think yes, we have the potential for that new delivery of products, whether that's curbside pickup, takeout, in person. It gives us more flexibility for consumers, which might help overall meet demand moving forward. I guess I kind of sit here today though, and I worry, and I think Lee brought this up already once about labor. All right, so I think moving forward, one of the issues is frankly going to be, can all these restaurants keep open their curbside delivery, in person, et cetera? That's going to take more people than it did in 2020, when maybe they were restricted in terms of what was in-seat dining capabilities. And so having the labor to be able to manage that, it's going to be interesting to watch as we go forward here in 2021. Now, let me be clear here. I think we wouldn't repeat what happened in 2020 if we were to talk about a bigger COVID-19 outbreak occurring in 2021, because all of the food service side has figured out better ways to handle it. So there is some help here, but to your question about just, hey, demand looks to be really strong. We look to be coming out of maybe the worst of COVID-19. We may have consumers with money in their pockets that are ready to go out and have a really good meal. And I'm already looking at the restaurants on the weekends in my windshield going, they're really crowded. And if you're going to push even harder, can you find the people to help in that situation? I think that's going to potentially be critical.
Yeah, in fact, you know, it might even go a little bit beyond that, because as you noted, we've really changed things. Restaurants in particular had to make a lot of changes. Some of the stuff that was already happening before the pandemic, but really emphasized by the pandemic, things like these meal kits, whether they're coming now, we're seeing restaurants offering, you know, take and bake kind of concept. That would be the pizza equivalent, but meal kits to take home. But we already had that trend kind of developing in some sense of whether it's home delivery or at the grocery store. And those represent kind of a blurring of that distinction, if you will, between food service and the retail grocery side. And I think those are all positive. There's more flexibility. There's certainly some question going forward after what we've been forced to do the last year in terms of cooking at home and all of those things. And kind of what does that do long term to home versus away from home kinds of food consumption patterns. But the other side of it is a lot of those things that kind of blur the line between food service and retail grocery are things that involve typically more processing. And so you're adding some additional labor requirements, in particular at the processing sector, to make those things happen. So those issues become pretty important going forward.
Lee, anything from you?
Well, I'll remind us that I think we'd all agree that demand has been strong, but demand is really hard to measure. And I think especially when you look at the situation last year, when there was, to use your word, Megan, such a pivot, right? So it's difficult to compare year over year, which we love to do, of how that demand has changed. And I think we're seeing, to add on to Daryl's point, I mean, there's a lot of success stories last year that we just don't know the trajectory going forward. When we seen, for example, ground beef was a tremendous success story. Ground pork was a success story. Pork loins were a success story. So how much of that is leveraged into the future, or do we go back to a little bit of how we traditionally ate things, or what we traditionally ate? So I think we should appreciate that demand has been strong, but also realize that there's a lot in flux here that could certainly change, and forecasting is even more difficult.
To that point, what do you tell the next generation of economists when they look back at charts for 2020?
I hope we can tell them to ignore that point in the data. And I think a lot of them, so we'll see how COVID-19 really plays out here at the end of the day. But you could look 10 or 15 years down the road when the next generation is starting, who will have very little experience with 2020, who will say, what happened in that period? Now, I hope that's what they can say, and we don't find this to be not one in a lifetime event, if you will. But I think it's hard one doesn't want to read too much out of everything that unfolded in 2020. It took a very specific set of events. I mean, I would want to remind us what each of these industries, when we talk cattle and hogs, were doing prior to COVID-19 outbreak. You think about hogs, and we were going to push a lot of hogs, and we were building supplies. It was a run of 4 or 5 years of growing inventory. And you throw that on top of then a COVID-19 outbreak, it made the backup, I think, a little more critical for a period of time than maybe for the cattle side, which, yes, growing, but growing at a much slower pace. So you have to take it all in total in terms of learning too much from that. And again, we get 10 or 15 years away from this, and I hope we can just put this one in the rearview mirror. And for those doing economic analysis, we essentially dummy out that year. It's one we should always forget.
Yeah, that's exactly right. We're going to spend a lot of time, and to that point, and this is kind of a heads up for folks watching this, much of our data at all levels in this industry, we always compare to a year ago. Lots of things have seasonality, so we compare to the same time last year. for the next few months, those year-over-year comparisons are going to be kind of out the window. Okay, so just be prepared for that, whether we're talking cattle on feed or hogs and pigs or meat prices or, at the wholesale, whatever it is. Because we're going to be comparing to something that was extremely unusual, and we hope it stays unusual, as Scott noted. So, it is going to be hopefully an aberration in the data going forward, but also in the short run, it's going to make knowing where we're at in 2021 and assessing what's happening in 2021 even more difficult, because we're going to be comparing it to a very unusual base a year ago. And I don't know about these other guys. As an economist, I use lots of charts, and I've gone back and added 2019 to all my charts so that you have something maybe that was a little more typical instead of just 2020 to be our comparison for what's evolving here in 2021.
Well, I've said this before. I think, we're going to see a lot of dissertations and theses being written out of COVID-19, right? And so I think there is certainly more we can learn from this, and that will be, part of our, educational base for understanding future, market events. Now, the one thing I think is, important to think about here is that COVID-19 happened, but there's a lot of other things that happened. And so to really tease out, COVID impact relative to other factors is becoming more and more difficult the further we're into this recovery process, and realizing there's been a lot of big events that's dictated, the market situation and outlook over the last couple of years, COVID being one of them, but also the trade war was a huge factor that shaped these industries. And we could all list those factors. And so I think that COVID not alone is impacting where we're at today and where we're going into the future.
So Lee, are you telling me that like 2018, 2019, 2020, and potentially 2021 will all have asterisks next to them in economic presentations in the coming years?
Well, that's maybe being a little facetious, but I will highlight that, certainly, yes. I mean, there's some big events there, but we've had big events in history too. So I think it's important to put them in perspective and realizing they're just part of the evolution of these industries, right? And they're going to make them stronger, and they're going to dictate, where we're going. But certainly, kind of being in the heat of it, yes. I mean, we've experienced some major challenges and opportunities here in the last couple of years.
So I think one of the challenges and opportunities that I want to talk about, though, when we think about some of those other factors, is African swine fever, which heading into the last couple of years has been interesting to follow on the hog side of things. We have seen cases pop back up again in recent weeks and months in China. How does that set the stage for the rest of 2021 for the pork industry, when we're already seeing strong demand and maybe a little bit less on the supply side, especially right now?
Well, I would even broaden it a bit. I mean, I think it points to the real protein deficit potential out there, and how, we can expect strong global demand for protein. It's not just pork. I mean, I think pork, we've seen record exports last year, really truly a historic year when we look at volume and prices. And it wasn't just China. Really, China took a lot of the attention for the first half of the year, but you can go down the list. There were several success stories for pork exports. I think maintaining those levels in 2021 would be a huge win. We're likely not to see the double-digit increases year over year. Now, African swine fever maybe gets us a little bit more, or the increase incidence gives us a little more optimism about those export scenarios. But it's really important to understand the whole portfolio for the U.S. when we look at exports, and this isn't just pork, that it's growing that whole portfolio, which really allows us to maintain that market access and maintain those export levels where they're at. So I think, again, to piggyback off what I previously talked about, it's just another big event that's going to dictate these markets. And I think the ripple effects are not just pork, that we're going to see impacts in beef and poultry as well.
Daryl, is the opportunity for beef in China one of the brightest spots for the beef industry in the coming years?
Well, it certainly is. It's one of, as Lee said, it's one of several, but beef demand in China has been growing rapidly in recent years. China eclipsed the US as the biggest beef importing country in recent years. And one of the things that we've talked about for several years, I think now becomes important in that China and Hong Kong really aren't separate anymore. We still get separate data. And so in my mind, and I've started routinely now adding those two together, particularly from a perspective of US beef exports, for example, and looking at the net, what's going on. And that net grew last year, even though Hong Kong is weakening a little bit, but some of that was that transshipment stuff between Hong Kong and China. But the growth in what comes as mainland China data was so strong last year in beef. And so, and to Lee's point, it really is, it's part of that picture of protein deficit in the last year or two, but it's also part of a fundamental increase in demand for beef in China that's been there, and the US and North America in general has been slower to get to be a part of that, but I think it's coming, and it's there, and it's a real opportunity. And of course, I don't want to take away from the fact that, you know, Japan is our biggest market still for beef exports. They were disrupted last year as a result of the pandemic, but they recovered pretty nicely by the end of the year. South Korea has been our fastest growing market most of the last several years. Again, there were disruptions in most of the markets. The biggest disruptions actually occurred with respect to Mexico, but again, we did see some encouraging signs at the end of the year that maybe that's recovered. I'm a little more concerned, and I continue to be concerned more about Mexico and just in general, their economic impacts and their situation perhaps is a little more challenging going forward. But nevertheless, I think there's lots of opportunity, and that's part of this bigger picture of optimism that we have, is that the trade stuff, I think for proteins in general, from a US perspective, looks pretty good.
Scott?
Yes, I think the both Lee and Daryl have covered things well here. I just, again, would go back to say, you know, you look at data here for a minute. So world beef consumption, as USDA reports it, for a number of years was sticking around 48, 49 million metric tons globally. The last 2018 through 2020 took a jump up. Why did it? China. You know, really no one else grew in very much in terms of global consumption. Now, trade flows changed,
Right.
But in terms of total consumption, this was very much a China story that's been unfolding. And so you can get really potentially optimistic, because when you look at China's level of beef consumption relative to pork consumption, it still pales. Now, to the pork side of this equation, you know, China used to consume 55, 56 million metric tons of pork pre all of their disease issues that they've faced. They're still roughly 10 million metric tons below that kind of historical consumption level. And if they return to that level of consumption, whether it be via trade or cleaning up their own issues with things like ASF, that certainly is going to be, I think, a demand pull going forward. And I sometimes say, let's not forget 10 million metric tons is about what we're producing here in the United States in total. And so I think I'm going to summarize it this way, and Glenn Grimes taught me a lot in the time I had to work with him. He used to always say, Scott, if pork production grew more than about 1.5%, I knew we were going to have lower prices. If it grew less than that, I knew we were going to have higher prices. The idea was, if he could understand the domestic supply side of the pork industry, he could guess prices fairly well. That's out the window today because there's so much demand change that we're facing, whether it's global or domestic for that matter, that this idea of doing price forecasting gets a lot harder when you have a lot more of these factors at play, and China just adds to it.
For those of you who are watching either on Facebook or in the webinar, if you have questions for our panelists, please feel free to submit them. We're always happy to throw some curveballs and some questions from our audience as well. We talk about the global demand picture. Do we get concerned about our ability to move product? We saw the issues we've been talking about, like the shortage of shipping containers and the ability to have access there. Is that something also that we're watching this year? And how does that potentially impact our exports and our trade?
I'll take a stab at it to begin with, I guess. I think that is part of the ongoing challenge. I mean, obviously, we've seen the recent, disruptions, and in general, we've had more issues in recent months with just demands on global transportation systems, broadly speaking. And if you think back to about February of last year, some of the earliest indications of pandemic impacts were actually in shipping and in port disruptions and those kind of things. Even before it was really an issue domestically in the US, we began to get those indications in China and other places that we had port disruptions. So, clearly that part was related to the pandemic. There's probably still some related to that, but just in general, again, I think the demands and the challenges on the global transportation system will continue to be one of many issues, as we've already alluded to, that will be one of the puzzle pieces that we have to sort of continue to address and keep an eye on.
It's an added cost, right? And I think we continue to, see that. And I mean, so it's another bottleneck. I mean, I would put it in the category of exchange rates. It's all impacting potential trade flows. Now, most of the time, those are rather short-lived. And so the system can work itself out when we talk about that infrastructure. But, when you have the highest pork prices we've ever had in 2020, and prices are looking even stronger here, you're adding that cost and potentially less competitive on the world market. Now, the fact that, we're seeing very strong demand globally, there's that deficit we're talking about, hasn't necessarily been a headwind to that, but I think it's something to certainly continue to monitor, because our supply situation suggests, we're going to maintain these relatively tight supplies, at least comparatively to what we've had the last couple of years, and still that big draw from the export market.
Scott, any additional comments?
So I think they've covered it fairly well. I would go one step further and just say, if those costs stay with us, it changes the landscape of where it's cheapest to produce products potentially, right? So we might get more production happening in some other countries that would have taken trade had costs of shipping been lower. So, to me, this, and I think Lee's hit the nail on the head very well here about this is just adding cost. And I think, how quickly can we undo some of the effects of COVID-19? And I say that because of I think we shuttered some things that we now can unshutter and are unshuttering, but tough to find labor to get some of those jobs done that we need done as well right now. And so do we get does it take longer than normal to get maybe costs back in what we might say more normal ranges, if you will? I think that's some of this post-COVID-19 that's really tough to figure out at this point in time.
Let's switch gears from more of a global conversation to bringing our focus back here at home as we take a look at the remainder of 2021. In the last couple of weeks, we've had a cattle on feed report, we've had a quarterly hogs and pigs report, and we've had USDA's prospective plantings numbers. As we take a look at the numbers coming from USDA, specifically on the prospective plantings, how does that equate into the bottom line for producers in the long run, and thinking about feed cost and input costs as well? Daryl, let's start on the beef side of things.
Sure. You know, one of the bigger challenges, certainly from a domestic market perspective, I think in 2021 is the reality here that we've got a very different situation than we've had for several years in terms of feed cost and so on. Feedlot cost of gain is going up. I don't think we're fully reflecting even sort of where we're at now. It takes a little time, you know, just depending on how things and when things were priced and so on. But going forward, there's every reason to expect that. So feedlots are going to be making some changes in some decisions going forward, facing higher cost of gain. One of the things I like to point out that may be a little bit different, potentially at least, to say hogs or poultry production. Things don't change as fast in the cattle industry, just given the biology. And so we're going to continue to feed cattle in 2021 because all of the cattle that we're going to feed are already on the ground. They're out there and they are going to get fed. But exactly how we feed them and the timing and the size that we want to put them in feedlots, those kinds of things may change going forward. That has implications for the feedlots themselves, trying to manage potential increased cost, you know, break-even cost. And then obviously any decisions they make about things like placement weights and so on then has implications for the feeder cattle market and sort of sending signals back to the country. If feedlots want to buy more pounds rather than put all those pounds on with higher priced rations in the feedlot, then we're going to have to provide a signal to the country to put that weight on those cattle before they get to the feedlot. So lots of folks, everybody in the industry really will be watching those conditions going forward. Another part that's really particularly critical from the cattle industry perspective, and we may be going to talk about this a bit more, and that would be from a drought perspective in terms of supplemental feed cost for folks that may be impacted directly by the drought. And so, you know, we're going to focus on forage and hay production to a large extent, but obviously supplemental feed becomes a part of that equation as well in terms of how folks will manage through some of the potential drought impacts.
And drought is next on my list.
I thought we were probably coming back to that.
We will get more in depth into that conversation as well, because I think that plays a larger role than just on the cattle sector. Lee, as we talk about the impacts on the hog side of things, what do we think about feed costs especially when we're seeing prices go up as high as they've gone on on the hog side of things?
Well, it certainly changes the calculus of things, and we can kind of walk through that a little bit. But I also want to highlight part of the reason why feed prices are where they're at is because of demand. And I know a lot's been talked about export demand for corn and beans, but feed demand is big, right? I mean, so we have smaller inventories than a year ago, but in relation to kind of recent times, there's still rather large inventories of hogs and cattle out there, and that's really helping drive that demand picture. When this feed cost situation started, you know, my initial thinking was, well, it just decreases the margin of error because we have a whole growing season in front of us. Now I'm not a crop guy, but I was proved wrong on that in the sense that we're realizing these higher costs, and now it has increased those feed costs. For pork, I mean, we're dealing with costs as high as 2014 levels. And that's certainly eating into the margins. Now we're seeing highest prices since 2014 for hogs as well. And so, you know, there hasn't been any major decisions, I think, as far as contraction or anything. I think it's too early to say anything like that. Now, you know, I think producers are obviously weighing the whole weight situation. We got higher price feed, but higher price hogs too. And so there is an optimal point there to feed those hogs. You know, weights I think are still rather large compared to a year ago or at year ago levels. So you know, the feed thing is something that is certainly we need to watch, but it's always about profit, right? So I think, you know, I would back off a little bit and say feed costs and costs are very important, but let's take it into the general situation of profit. And right now, it is rather profitable in pork production, especially when we compare to what we experienced last year, obviously.
Could we potentially see, if input prices stay up and hog prices stay up as well, start to see hog weights drop back a little bit?
So I think it's twofold. Yes, I think that's going to start eating into those hog weights. Now, part of the issue with comparing again to our year ago levels is we actually pulled some hogs ahead in March last year. So that brought weights down. So we're kind of comparing to a lower weight in the March data. And then we all know what happened in April, May, and June with the backlog and increasing those weights. So compared to year ago levels, it's pretty tough to really understand that fully. But I think weights, I think we'll start to see those maybe dialed back into what we kind of normally see. The other big factor is seasonality. And so, those weights will start to be impacted by the hotter weather, which will pull them down as we typically see, I think, which will be counter to what was experienced last year.
So let's talk drought conditions. First, let's look, Scott, as we take a look at the drought monitor and we see some pretty dry conditions, what does that mean overall potentially for the livestock sector?
Yes, I think that we can answer maybe a little differently for both of these commodities. Darrell alluded to hay and pasture conditions. To me, as you look at where that drought's located, it's more troubling potentially for the cattle industry right now than it is for ultimately what we put in the bin for corn and soybeans this fall. With that, and so we have a current issue that to me is much more pasture and hay based than anything else. I guess I kind of sit here and go, that's going to keep that cow herd from expanding too much from a U.S. perspective. There may be some places around the country that expand, but that Western drought has been pretty tough for a number of months now that I think keep us in check fairly well. I like to come back and talk about this as risk from a feed cost side, and maybe this is more to hogs than cattle, but we had hoped maybe for more acres in prospective plantings than we got, right? If you're a livestock producer, you might have hoped we could have gotten 93 or 94 million acres of corn that were going to be planted. I go, it's too early to really figure this out, because if we put a bumper crop or a good crop in the bin this fall, I think we all probably know prices will tend to move lower than where we sit today. But if we don't get more acres in the ground, it's a wet spring, it's tough from a corn and soybean standpoint, and then it turns dry, we know we have higher feed costs coming. And so the uncertainty for producers is really tough, because you don't know whether you should or shouldn't expand without having a good idea of feed costs. I think a lot of folks may choke at trying to protect a lot of those feed costs right now, given they're much higher. Sure enough, if we come back with the June acreage report and we get 93 or 94 million acres of corn, and we get right around 90 million acres of soybeans, I think that changes the calculus for feed costs moving forward as well. So to me, all of this discussion is risk-based, and we don't have the buffer that we would have come into all of this a year ago with. And soybeans in particular are mighty tight when you look at current ending stock projections. And I think that risk is what livestock producers have to generally figure out how to accommodate. And as much as I'm terrible at forecasting market prices for cattle and hogs, I'm equally bad about forecasting the amount of precipitation we're going to get in the country this year.
You're telling me you're not like weatherman material?
I'll tell you tomorrow whether it rained yesterday.
Darrell, talk to me a little bit about how it shapes up in cattle country as you look at it.
Sure. Much of the Southwest U.S. was in a drought most of last year. It got worse through the summer and into the fall in some areas. And there were sort of sporadic or anecdotal indications of some movement. If you look at the data on January 1, Colorado was really the only state where we saw significant herd liquidation last year. Their cow herd was down. Their replacement heifer numbers were down. They just didn't have the capacity to hold those cattle. And in spite of the impacts that those folks felt and in other parts of the Southwest, I don't believe that from a broader market perspective, we saw enough liquidation last year to really say that, of course, last year being last year, how do we detect those impacts, right? But I don't think there were a lot of broader market impacts. I think most of the drought impacts were felt by the individuals involved in them and dealing with them, whether it involved liquidating cattle or moving cattle or the feed costs that they were incurring or whatever. What really worries me about this year is we're starting into a growing season with these widespread drought conditions continuing in those areas, but now really potentially expanding into some areas where there's a lot more cows. If you look just from a beef cow herd standpoint, the Dakotas, North Dakota in particular, down into at least the northern half of South Dakota, parts of Texas, those are regions that have a much higher density of cows compared to some of the Southwest regions. And this time of the year, if we sort of interrupt or preempt early spring pasture and hay growth, that will force some decisions much quicker than a drought that evolves in the second half of the year typically. We could be seeing some significant impacts, as in May or June. I remember back to 2011 when we had such a severe drought in the southern plains in Texas and Oklahoma, and it was a drought that carried over really from the fall before. And so, in April, all of a sudden we realized it was dry and we weren't going to have a normal spring green up. And by June, we were seriously facing liquidation of herds because, coming into a drought in the spring it leaves you very little opportunity or very little flexibility if you just don't grow any forage at all early in the year. So I think that's the risk going forward for the broader market, as well as obviously for folks that potentially face those conditions, is to think about the fact that we could see this cattle market situation potentially change pretty significantly between now and say mid-June in terms of the possible impacts.
Lee, any other comments on the hog side of things?
No, I think it's, we're all watching the same things, and they obviously have implications for feed costs, but I'll highlight that feed cost isn't the only component. It's what we talk about a lot. It's the majority of the cost, but there's a lot of inflationary costs that were accelerated last year that I think are here to stay. And that's increased that base when you talk about costs. And so, that's changed I think a lot of our models about, what is the cost of production and what those potential break-even prices are.
As we start to wind down our conversation, and again, thank you so much for blocking out a little bit of your busy schedules to chat with us about the last year. And as we look ahead, let's take a quick look ahead. As you look to the rest of 2021, what are some of the focuses you have, and what are some of the focuses that you think producers in the livestock sector, Lee for hogs and Daryl for cattle, need to focus on as they're trying to manage the rest of this year? Lee, I'll start with you.
Well, when you look at where prices are, and I think if you go back a year from now, expectations, even pre-pandemic, were hog prices in the mid 60s, 70, right? And we're staring at the five front out contracts in CME are over $1. And the market is offering tremendous opportunity to offset risk. Now, and there's a lot of ways to do that. I think now, is it a time to hedge those prices or to buy put options? I think that's really producer specific, but the margin for error has grown a little bit in the fact that you can buy a pretty far out of the money put that's still above break even prices. And so I think, given what the market is offering, I think many of us, didn't expect this a year ago. And to see that, there's that opportunity, because a lot of things could happen in the next 6 to 12 months that may change that price outlook. And so I would take advantage of some of those opportunities, but also allow for the upside in the market, because I think, as you've heard from all of us, there is some optimism out there. And I think, markets have really been drawn from that demand situation. And so, allowing that, but also allowing or preventing for some downside risk, I think is really prudent where we're at today.
Daryl?
Yeah, similar situation. I think, broadly speaking, I do think there's a fair amount of optimism built into the cattle markets, both fed cattle and feeder cattle, just looking at the futures markets, particularly for the second half of the year, really sooner than that. As fed cattle market got trapped in the doldrums here through much of the first quarter, took forever to break out of it. We kind of have now. And we got into this weird situation, about 2 or 3 weeks ago where we had the June futures contract premium to April, which I went back and looked, and it's been since 2011 or something since that had happened, a long time ago. And of course, the April contract has been and still is a little bit premium to the current cash market, although cash is trying to catch up now. So, and again, that just sort of reflects the optimism going forward, and as well as some of the struggles we've had to this point in the year to kind of work through some of the bigger supplies and so on that we've had. And in feeder cattle markets, again, pretty resilient. They took a big hit after the prospective plantings report last week for a day or so, or part of a day, but then have bounced back fairly well. And if you look at where these fall feeder cattle contracts are, as Lee said, I think as a cattle producer, you really want to seriously think about, taking advantage of an opportunity to at least put some minimum price coverage out there. Economists probably would argue that we try to get people to use risk management more than they do. And if after last year you're not thinking about, or at least willing to seriously consider doing it, then I'm not sure what would ever get you to do it. We do have some optimism going forward, but we also know now that we are very subject to all kinds of things that could be an issue. And we do have some clear challenges going forward. We've talked about the drought. We've talked about the feed cost, and in particular, the broader macro stuff. Perhaps Scott will talk about some of that, and exchange rates and trade. And there's a number of challenges as well. So there is optimism. There's reason to be optimistic, but there's also reason to be a little bit cautious and take some precautions.
Scott, I will let you have the final word today.
So thanks, Megan. I'll see whether I can hit a single or a double, or I strike out trying to swing for the fence here. But I start a few things. So number one, we've come through so much in terms of just how much COVID-19 has jolted these markets. I think hogs and pigs for a minute here, and this is so the report showed Missouri down 40,000 sows, and I'm struggling to find that we lost 40,000 sows in Missouri. That is not me taking a swipe at USDA for not doing a good job. It's more me saying I wouldn't want their job right now. I think COVID-19 made it difficult, but there are potential supply risk associated, I think, with some of what we're seeing in these markets. I think I could tell a similar story for cattle numbers as well, that bits and pieces of that I might have done differently. But yet again, I go, that's a tough job for USDA. Acreage, equally, I go, tough to maybe survey for corn and soybean acres in prospective plantings, especially coming out of COVID-19. So I think there's some supply side things that also add to the risk going forward. Now to general economy, and I think Daryl set me up very nicely to say, I think we're at this point right now where everybody's ready to get out. Everybody's ready to spend money. Everybody's ready to travel. Let's not get our blinders on too much to what happens later this year. And I don't want to forecast because I'd be terrible at it. However, if we don't do more stimulus, or we find consumers without money in their pockets, they blew it all on the trip to Hawaii that they had postponed for months on end. What's that mean for meat demand? And so we could have lower prices for both cattle and hogs from the demand side, and that's just domestic demand. I mean, let's take international demand for a minute. I always go, I can sum it up in one word: China. Is there risk with trade to China? Absolutely. And sometimes I go, it cuts so many different directions, because if ASF becomes a really big problem in China, what's that do to feed costs? Right? So they may demand less corn from us. And so we just sit here with, those are the things that I'm watching. What's happening in China, I think, is going to be important on the trade front. What happens to the domestic economy in the second half of the year? Consumer spending versus gross domestic product are different things. And we're learning those are different things, having come through COVID-19. And then just the supply side, and how much of where we currently sit have we caught correctly in terms of the data available to us, versus what did COVID-19 throw us in terms of a curveball on the supply side. All of those are risks that can be managed today. And I think Lee stated very well, there's upside potential here. So be careful about locking yourself out of upside potential, but think about that risk side as well.
Gentlemen, I thank you for your time this morning, your comments and your insight. It is greatly appreciated and always wonderful to see you. Hopefully, we get to see more of you in person over the rest of 2021, and webinars will become tools, not necessities.
Thanks,
Thank
Megan.
you so much.
Thank you.
You.
Have a great day. I'm Megan Grebner for Brownfield.